Welcome everyone, let's jump right in. Today I'm putting on my hat as a professional sell-side equity analyst and we are going to walk through a rigorous, fundamentally driven valuation. We're skipping the market hype and diving straight into the hard numbers. Our focus for this explainer is Cabot Corporation, a true specialty chemicals giant. We're going to use their latest 2025 and 2026 filings to extract the actual on-the-ground operational reality of this business and build a strict discounted cash flow model. So let's get into it.
Here's our roadmap. We'll hit the business model and segments, map out their competitive moat, check out the financial health and margins, derive the cash flow, and finally, run through our step-by-step DCF valuation.
Starting right off with Section 1, Business Model and Segments.
So, at its most basic level, Cabot is essentially an alchemy business. They take low-value hydrocarbon feedstocks, stuff like heavy fuel oil and coal tar, and they convert them into extremely high-value reinforcing carbons and conductive additives. Now, why does this matter to us? Because these microscopic materials are absolutely critical for two massive end markets. They provide the structural integrity for premium vehicle tires and the energy density needed for electric vehicle batteries. Honestly, without Cabot's carbon black, a tire would literally degrade in less than 100 miles.
And these physical products translate directly into two main revenue pillars. First up is reinforcement materials, which pulls in about 63% of their revenue, or roughly $2.34 billion. This is their massive, mature cash cow tire segment, and it steadily grows at about 2 to 3%, basically moving in lockstep with global GDP. But the second pillar, performance chemicals at 34% of revenue, or $1.25 billion, well, this is the really exciting part. It's a high-margin, rapidly accelerating segment producing battery materials for EVs. Management is actually projecting a massive 16% compound annual growth rate for this division through the end of the decade.
Moving on to Section 2, the competitive moat.
In the tire business, Cabot's primary customers are top-tier giants. Michelin, Bridgestone, companies like that. And these guys prioritize supply security and consistency above absolutely everything else. They don't just switch suppliers to save a couple of pennies. They are bound by this process called homologation. It's a highly rigorous, months-long qualification process required just to ensure safety standards are met. This creates exceptionally high switching costs, effectively locking customers in and establishing a deeply entrenched relationship.
But the moat gets even wider when we zoom out and look at the physical and legal landscape. Cabot benefits massively from what we'll call an environmental and logistical moat. Strict environmental regulations in the US and Europe act as a massive license-to-operate barrier. It effectively bans cheaper, dirtier competitors from building new plants. Plus, think about this. Carbon black is a super low-density material. It's mostly air. That means it's incredibly expensive to ship over long distances, so you have to manufacture it locally. This physical reality creates a massive regional fortress protecting Cabot's existing global footprint.
All right, Section 3, Financial Health and Margins.
What's really fascinating here is the financial divergence we're seeing. In fiscal year 2025, Cabot's revenue actually fell by $281 million because of a weaker macroeconomic environment. But check out their margins. Gross margin remained incredibly strong at 25.3%, and operating margins actually expanded to 16.7%. How is that even possible with falling revenue? Well, this is ironclad proof of Cabot's formula-based pricing contracts. They are able to pass raw material costs directly through to their customers. It completely protects their profit engine even when cyclical volumes drop.
Turning to the balance sheet, a key health indicator we always check is leverage. Cabot is sitting at a very conservative net debt to EBITDA ratio of 1.42. They're holding $258 million in cash against $856 million in long-term debt. So what does this mean? It means they have a very safe leverage profile that is well within the safe zone for an industrial chemical company. They're highly capable of weathering economic shocks.
Section 4, Cash Flow Derivation. The absolute crucial takeaway here is earnings quality. Look at this. We compare a net income of $331 million against an operating cash flow of $665 million. That gives us a massive 2.01 times earnings quality ratio. This is a vital metric for us. It proves beyond a shadow of a doubt that Cabot's profits are not just paper gains stranded in working capital or inventory somewhere. They are backed by highly robust, actual cash hitting the bank account.
So let's walk through the exact math to derive our free cash flow, pulling it straight from their financial reports. We take that super robust operating cash flow, $665 million, and we subtract their capital expenditures, the money they need to actually maintain and grow the physical business, which came in at $301 million. That leaves us with a huge $364 million pile of free cash. This cash easily covers their dividends, share repurchases, and debt paydowns with plenty of room to spare.
And finally, Section 5, Step-by-Step DCF Valuation. Let's model this out.
To kick off our DCF, we first need to understand the risk profile of the stock, which is represented by its beta. Cabot has a historically low beta of 0.78. This lower volatility directly reflects the non-discretionary nature of replacement tires. Think about it. Even in a severe recession, if your tires are bald, you have to replace them to get to work. That physical necessity anchors their revenue and significantly lowers the risk for equity investors.
Now, to calculate our weighted average cost of capital, or WACC, we need to explicitly declare our baseline assumptions. As you know, exact market premiums aren't just printed in a 10K, so we have to use sensible defaults. Alongside our 0.78 beta, we're assuming a risk-free rate of 4.5% based on current 10-year Treasury yields. We're also using a standard equity risk premium of 5.5%. For the cost of debt, we're assuming 5% pre-tax, which is totally justified given their stellar interest coverage ratio of over 8 times. And finally, we'll use a normalized tax rate of 25%.
Let's blend all that together. Based on a market cap of $4.23 billion and total debt of roughly $1.23 billion, their capital structure sits at about 77% equity and 23% debt. Using the capital asset pricing model for our cost of equity and our after-tax cost of debt, we blend these weights to establish our discount rate. Doing the math, we get an estimated WACC of approximately 7.6%. This is the hurdle rate we're going to use to discount our future cash flows back to today.
Okay, time to forecast. We are projecting the unlevered free cash flows over an explicit 5-year period. For this, we're assuming a 5% blended revenue growth rate. And this isn't just a random guess, it's rooted directly in management's stated 16% compound annual growth rate for that high-flying battery materials segment, blended right into the steady 2 to 3% GDP growth of the tire segment. We're also going to assume that operating margins will hold perfectly steady at their historical average of 17%, thanks to those brilliant pass-through contracts we talked about earlier.
At the end of our 5-year forecast, we have to assign a terminal value to represent all the cash flows generated from year 6 into perpetuity. We're going to use a 2.5% terminal growth rate here. This is a highly sensible assumption because it perfectly aligns with the long-term structural GDP growth of the global tire replacement market, which, as we've established, is the bedrock of their entire business.
And here we have the grand finale. When we take those projected 5-year cash flows, calculate the terminal value, and discount it all back to the present day using our 7.6% WACC, we arrive at our resulting intrinsic value per share. By tying this entire financial model together, we've successfully moved from the physical reality of carbon black inside a tire straight to a precise, strict valuation based strictly on fundamental cash-generating power.
As Cabot's management notes in the filings, the company is beautifully positioned to navigate macroeconomic challenges. By mapping out their physical reality, their environmental moat, the massive switching costs of homologation, and those formula pricing contracts, we can see exactly why the highly resilient valuation we just modeled isn't just a spreadsheet exercise, it's highly achievable in the real world.
Which leaves us with this final thought. Right now, Cabot is trading at roughly 11 times earnings, all while successfully pivoting a huge division to supply the booming electric vehicle market. Looking at the rigorous math we've just walked through together, you really have to ask yourself, is the broader market fundamentally mispricing this cash machine that's hiding right in plain sight? Thank you so much for joining me on this explainer. I highly encourage you to review the analysis, look at the numbers, and decide for yourself.